All right, it's November 6th, 2025. The market is at a really critical inflection point, squeezed between external political pressure from Washington and its own internal fragility. Let's get right into the numbers.
36. That's the number. That is the number of days the U.S. government has now been shut down. And that shutdown, it has a very direct, very real consequence. Starting tomorrow, we're expecting a 10% cut in air traffic. So this isn't some far-off problem, it's an immediate economic threat, and it's happening now.
Okay, here's our game plan for today. We're going to quantify the shutdown threat, take a hard look at the market's fragile state, identify the key sector battleground, and then look at the carnage in growth stocks. From there, we'll lay out 3 possible scenarios and wrap up with some risk-defined setups.
First things first, let's quantify the disruption. What is the direct, measurable impact of this political deadlock?
Well, the facts speak for themselves. We're at day 36, which officially makes this the longest shutdown in U.S. history. We have critical people, air traffic controllers, TSA agents, working without pay. We've already seen 3.2 million passengers hit with delays and cancellations, and now we have an official warning from the Transportation Secretary talking about impending mass chaos and even potential airspace closures. This is a systemic risk that's boiling over in real time.
Okay, so that's the external pressure. Now let's see how all of this is hitting an already vulnerable market. What's really striking is the speed of this sentiment shift. In just 1 month, we've swung from greed all the way to extreme fear. And you can see this right on the charts. The S&P and the Nasdaq 100 have both pulled back to test their 20-day moving average. That is a key short-term level, a line in the sand that bulls absolutely need to see hold. Meanwhile, you've got the Russell 2000 testing its 50-day. These are the technical battlegrounds right now. In this chart right here, it tells the whole story of where the money is flowing. Last week, the tech-heavy Nasdaq was down 2%. The S&P was basically flat. But look at transports. They were up 3%. This is a classic defensive rotation out of those high-flying growth names and into tangible value sectors. So this rotation is creating a really clear split, a clear divergence at the sector level. Let's break down the 2 opposing forces in this environment. On one side, you have the airlines. They are facing direct revenue hits from this shutdown, total operational chaos. On the other side, you've got the defense sector, which is suddenly on watch because of reports of potential military action in Venezuela. That's a potential catalyst for names like Lockheed Martin and Raytheon. You couldn't ask for 2 sectors on more divergent paths right now. Okay, let's zoom in from the sector level down to individual stocks because the market's mood right now, it's just absolutely brutal. There's no room for error. Just look at this. Duolingo, Fortinet, ELF Beauty. All of them got crushed after their earnings. And the most important part here is the reason why. Weak forward guidance. In this kind of risk-off environment, investors are just fleeing high-valuation stocks at the slightest hint of future weakness. The price for any imperfection is severe. Just a quick disclaimer, this content is for educational purposes only. It is not financial advice. Please always do your own research. And hey, if you're finding this analysis valuable, a quick like and subscribe is really appreciated. It helps the channel out a lot. Okay, so we've got the data points. Let's pull it all together and build a forward-looking framework. I see 3 probable paths over the next 1 to 2 weeks. Our base case is that the shutdown drags on and the market just chops sideways, with the S&P 500 holding that 20-day moving average. The bull case gets triggered if we get a shutdown deal. That would remove a ton of uncertainty. And the bear case? That gets triggered if the shutdown actually gets worse and we get a decisive break below that 20-day. So we can really boil this down to simple binary triggers. The bull trigger is a shutdown resolution plus the 20-day moving average holding as support. The bear trigger is the shutdown getting worse as that key technical level breaks. It's really that simple right now. So the logical question becomes, how can you position for these outcomes but with defined risk? Let's walk through a couple of potential strategies that come directly from this analysis. Here are 2 ideas that really reflect that sector battleground we talked about. For a bearish view on airlines using the JETS ETF, one might consider a put-debit spread. That's a strategy that profits from a drop in price while capping your maximum loss. The key risk there? A sudden shutdown deal could cause implied volatility to just collapse. On the other side, for a bullish view on defense through the ITA ETF, you could structure a call debit spread, which profits from a price rise, again with defined risk.
Now, a quick but very critical warning about options. All of your capital is at risk. On certain strategies, losses can even exceed the premium you paid. This is not a recommendation to trade. Sizing and discipline are absolutely essential.
And to close us out, remember, this is a market update. It is not trading advice. Always trade your own plan.
So, I'll leave you with this question to think about. With the market so ruthlessly punishing any sign of future weakness and rewarding tangible value, are we just seeing a temporary fear-driven rotation? Or is this the beginning of a fundamental regime change in what the market truly values?